This mini lecture is intended to help you begin to glean firm performance information using financial statements. Exhibit 2 of the Ben & Jerry's case presents Ben & Jerry's financial highlights from 1985 through 1994. The top part of the exhibit shows information taken from the income statement of Ben & Jerry's, and the bottom part provides information taken from the balance sheet of Ben & Jerry's. Three quick and dirty measures that you can construct using this table of financial highlights are return on sales, return on assets, and return on equity. These are three performance measures that we'll focus on in this course. Return on sales is equal to net income divided by total sales. Net income is the firm's profit after tax in a given year. Total sales is the total revenue that the firm receives in a given year. Return on assets takes net income and divides it by the total assets in the firm, usually at the end of a year. And return on equity takes net income and divides it by the total shareholders' equity at the end of a year. Going back then to the exhibit that provides financial highlights for Ben & Jerry's, these four lines are used to construct these three measures. There are a number of things that you can do with this financial information that help you understand firms' performance. You can examine the growth rates of sales and profits or net income over time, looking at long-term trends using measures like compound annual growth rate, or changes in those trends by examining year-over-year growth rates. You can also look for changes in the measures of performance, return on sales, return on assets, and return on equity over time. And then you can dig a little bit deeper to think about what are the driving forces behind those changes. Changes in the ratio of sales, general, and administrative expenses to sales, changes that relate to the cost of goods sold to sales ratio, and changes that relate to R&D to sales ratios. You also might want to ask the question, how well is this firm performing relative to competitors, and how well is this firm performing relative to other firms that I might invest in overall? Is this a good place to put my capital? The best measure for this, in my opinion, is the return on equity measure. So across the entire economy in 2012, the median return on equity was 12.9%. If you go back historically, that median is almost always between 10% and 15% in any given year. Finally, with the Ben & Jerry's case, you might want to dig a little deeper, and as you will learn in the accounting course, there are many, many ways to do this. You happen to be provided in Exhibit 2 the working capital figure for Ben & Jerry's over time. The working capital number represents the value of the inventory that Ben & Jerry needs and the cash on hand that it requires to run the business. You can construct a measure called days of working capital by taking the working capital figure, dividing it by the cost of goods sold figure, and multiplying by 365, i.e. the number of days in a year. Mechanically, that involves looking at these two lines in the exhibit. So let me conclude with a question. How has Ben & Jerry's days of working capital changed in the last 5 years? And why has it changed?